Assalamu alaikum wa rahmatullah. This is Major Finance, Chapter-8. We'll be starting today with the financial crisis in emerging market economies. It often occurs due to internal and external factors, leading to several economic turmoil. So understanding the actual dynamics and stages of this crisis is crucial to mitigating their impact and formulating preventive measures. And we will discuss the different phases of financial crisis in emerging markets, focusing on these stages and causes using specific case studies. And we'll also learn about real-world examples and how to mitigate those in details, inshallah. So let's start with the dynamics of financial crisis in emerging market economies. The first phase, or the first stage, we can say, it is the initial stage. The 1997 Asian financial crisis serves as an example of the initial phase. Structural imbalances, high debt levels, and over-dependence on short-term capital inflows made economies like Thailand and Indonesia vulnerable. Unsustainable fiscal policies and weak financial regulations triggered the crisis, leading to investor panic and capital flight. Moving on to the second stage, which is the currency crisis. The sudden devaluation of the Mexican peso due to speculative attacks and excessive borrowing led to a currency crisis. Unsustainable exchange rate policies and high interest rates triggered capital flight, resulting in a severe devaluation of the peso, ultimately requiring a bailout from the International Monetary Fund (IMF). Moving towards the third stage, which is the full-fledged financial crisis, we can say the Argentine financial crisis per se, which culminated in economic collapse due to a mix of financial currency devaluation, political instability, and also unsustainable debt levels. The collapse led to bank closures, social unrest, and a default on international loans, causing widespread economic hardship all over Argentina. So let's move towards the actual preventive measures in the emerging market financial crisis. The first one is to strengthen the regulatory mechanisms within the country or within the financial system. Weak banking regulations and inadequate supervision led to a banking crisis in Turkey. Turkey implemented extensive banking reforms, improved regulations, and strengthened the banking sector's governance to prevent future crises. We can also refer to the collapse of Icelandic banks in 2008 due to excessive borrowing and currency mismatches highlighted the need for greater transparency and market discipline. Iceland implemented reforms, increased transparency, and introduced better risk management practices to regain trust in its financial system. The second step we can maintain to sequencing financial liberalization. For example, Chile's gradual and sequenced financial liberalization helped it navigate the Latin American debt crisis relatively better than its neighbors. A well-sequenced liberalization process ensured better risk management and stability in the financial sector. So let's move towards the case studies we want to study, and from that we will learn about the preventive measures and also the stages they have crossed and they have faced and what they have decided to do in those cases. So starting with the 1997 Asian financial crisis, it can be said a contagion of currency devaluations and economic turmoil. So it stands as a pivotal moment in recent economic history, which started in Thailand in July 1997 and swept across East and Southeast Asia like a wildfire, wreaking havoc on currencies, stock markets, and economies. So let's delve into the key aspects of this event. The first one we need to address is the early spark. The first one is the Thailand's mismanaged liberalization. Rapid financial liberalization without adequate regulatory frameworks led to Thailand's banks lending heavily to conglomerates. These borrowed heavily in foreign currency, leaving them vulnerable to exchange rate fluctuations. Thailand maintained a fixed exchange rate for their currency, attracting foreign investment but making exports less competitive. When neighboring currencies started depreciating, the pressure on the currency mounted. So we can say it as the currency went under pressure. The third stage was the loss of confidence in their currency triggered capital flight, rapidly depleting. Thailand's foreign exchange reserves also decreased rapidly. So in July 1997, Thailand was forced to float the currency, causing its immediate devaluation. Moving on to the domino effect, which refers to events one after another. So the first one is the contagion spreads. Thailand's devaluation triggered panic across the region, sparking similar currency crises in Indonesia, Malaysia, South Korea, and Philippines. These countries also had similar vulnerabilities such as overvalued currencies, high foreign debt, and weak financial systems. As confidence plummeted, investors rushed to withdraw their money from the region, further weakening their currencies and fueling inflation and economic contraction. The crisis led to widespread job losses, unemployment problems officially, business closures, and social unrest. Millions of people fell into poverty as economies shrank and currencies lost value. So let's say, how did they recover from their situation? The IMF provided bailout packages to affected countries, imposing strict austerity measures and financial reforms. So they got a huge amount of international support. Gradually, the road to recovery was long and arduous, taking several years for affected economies to stabilize and resume growth. So from this, what did we learn? First one is to make prudent macroeconomic policies, maintaining sound fiscal and monetary policies, avoiding large current account deficits, and managing foreign debt prudently are crucial for financial stability. The second point we have learned is to have strong financial regulations, a robust regulatory frameworks, and effective oversight of banks and financial institutions, which are essential for preventing excessive risk-taking and ensuring financial stability. The third point we have learned from that is to give some flexibility on currency regime. Fixed exchange rates can create vulnerabilities in emerging markets. Flexible exchange rates can provide better shock absorption and during external turmoil. The final and the last but not the least point is to have transparency and good governance all over in all sectors, with strong institutions, strong transparent policies, and responsible lending practices, which will foster confidence and mitigate the risks. So the 1997 financial crisis remains a significant event in shaping the global financial landscape. It serves as a cautionary tale of the dangers of financial management, rapid liberalization without proper safeguards, and the interconnectedness of global financial markets. By understanding the causes and consequences of these crises, we can gain valuable insights into building more resilient and sustainable economic systems for the future. Moving on to another case study is the Icelandic financial crisis of 2008. It was a major economic and political event that sent shockwaves through the small island nation. It involved the collapse of all three of Iceland's major privately owned banks in late 2018, following problems in refinancing their short-term debt and a run on deposits in the Netherlands and the United Kingdom. So to term it as a volcano of debt is not undermining at all. So let's discuss the key aspects of that event, starting with the perfect storm of causes. The first one is the rapid and unregulated growth of the Icelandic banking sectors. In the years leading up to the crisis, Icelandic banks grew rapidly through international expansion, often financed by debt. This expansion was fueled by light regulations and the lack of oversight, following by mismanagement and overconfidence. Bank executives engaged in risky lending practices and ignored warnings about the sustainability of the debt levels. Another can be global financial crisis, which currency pegged to the euro. Iceland's krona was pegged to the euro, making it difficult for Icelandic businesses to compete internationally and exacerbating the country's current account deficit. So the crisis was not isolated to Iceland only. It occurred within the context of the larger global financial crisis of 2008, which further eroded investor confidence and triggered capital flight from Iceland. So moving on to the domino effect, the collapse of the banks had a devastating impact on the Icelandic economy. The krona plummeted in value. Foreign currency transactions were virtually suspended for weeks, and the stock market lost over 90% of its value. Iceland underwent a severe economic depression, with GDP falling by 10% in real terms between 2007 and 2010. So how did they recover from the huge amount of crisis they were facing? So they eventually began to recover from the crisis, and thanks to a number of factors, including international bailout, obviously. Iceland received a 2.1 billion euro bailout from the IMF and other countries as well. So they have the government negotiated debt restructuring agreements with creditors, reducing the burden on the Icelandic economy. Iceland also imposed capital controls to prevent further capital flight and stabilize the krona. And also the crisis led to a wave of public anger and protests, which ultimately resulted in the resignation of the government and the adoption of new political reforms. So from this case, what have we learned? Governments need to have strong regulations in place to prevent banks from taking on excessive risks, which refers to prudent financial regulation. Countries need to maintain low inflation, manageable current account deficits, and sustainable levels of debt. Financial institutions need to be transparent about their activities and held accountable for their actions. Iceland's economy was heavily reliant on the financial sector. A more diversified economy is less vulnerable to shocks. So we can outline 4 points. First one is the prudent financial regulation. The second one is the sound macroeconomic policies. The third one is transparency and accountability. And the last one is the diversification. So the Icelandic financial crisis is a complex story with far-reaching consequences. By understanding the causes and consequences of the crisis, we can learn valuable lessons about the importance of responsible financial management and building resilient economies. So moving towards another case study is the South Korean crisis, which happened at the same time as the Asian crisis, 1970 to 1998, which stand as a stark reminder of the potential pitfalls of rapid financial liberalization and globalization in emerging markets. Here's a closer look at the key aspects of the case study. The first one is also the rapid financial opening. South Korea excessively liberalized its financial system in the early 90s, allowing foreign banks to enter and domestic banks to expand lending. However, this lacked adequate regulatory frameworks and prudent oversight. Cables and moral hazard is the large Korean conglomerates benefited disproportionately from government guarantees and cheap loans, taking on excessive debts and engaging in investments with limited accountability. The Korean remained artificially strong due to government intervention, discouraging exports and making foreign debt burdens heavier. So the Thai baht devaluation in 1997 triggered regional financial panic, leading to capital flight from South Korea. High current account deficits, mounting corporate debt, and fragile banks made South Korea particularly susceptible to the shock. Investor confidence also plummeted, causing massive capital outflows and a sharp depreciation of the yuan, fueling inflation and further undermining financial stability. The yuan's devaluation eroded the value of domestic debts, pushing corporations and banks into insolvency. Bad loans soared, crippling banks and hindering trade flow, triggering a recession and a widespread unemployment. It also moved towards social unrest. Public anger towards government bailouts and the economic hardship fueled protests and political instability. How did they recover? The same old story as the IMF bailout. South Korea sought a $58 billion bailout from the IMF, implementing painful austerity measures, corporate restructuring, and financial sector reforms. So, what have we learned? The crisis exposed the dangers of unmanaged financial liberalization, the need for strong regulatory frameworks, and the importance of prudent macroeconomic policies. So the case study of South Korean crisis offers valuable insights for other emerging markets seeking to integrate into global financial system, which is the gradual sequence liberalization. Financial opening should be accompanied by robust regulatory frameworks and institutional capacity to manage risks. A sound macroeconomic policy, stable exchange rates, low inflation, and manageable current account deficits are crucial for maintaining investor confidence. Thirdly, corporate governance and accountability. Ensuring transparency and sound risk management practices within domestic firms is essential. Financial sector safety nets should have strong prudential regulations and effective bank supervision, crucial to prevent widespread banking crisis. By understanding the causes and consequences of the South Korean crisis, emerging markets can better navigate the challenges of globalization and build more resilient financial systems. We'll continue from this part onwards. We will learn about another 2 or 3 cases similarly, and finally we will complete our chapter and course inshallah within our next class. Assalamu alaikum wa rahmatullahi wa barakatuh.